Hello, everyone, and welcome to BFW 2401. This is week 9. We are talking about market risk. This is the recording of part 2. Now, in the first part, we talked about the risk matrix, and we show you how, theoretically, we explain it. Now we will do the calculation and give some examples, and we will also talk about what we call back simulation and Monte Carlo simulation and the regulatory models briefly. Now, if you, so this is the, this is part 2. And part 2, when we talk about it, we are talking about the risk matrix model, as I told you. We will cover in this. This was, as explained in the first part, followed by the former chairman of JP Morgan. And the risk matrix is calculating daily earning at risk for 1 day, which we call it the DIR, for 3 items: the fixed income, foreign exchange, and for the equities. Now, the fixed income one, which is actually the rest are okay. We have just a simple, concept in econometrics, which is trying to get it from the, because it's a risk and it's random. So we are using the normal distribution. We want just to calculate the area under the normal distribution, which, reflect that risk. Now we do it for the fixed income, we do it for the foreign exchange, and we do it for equities. But when we do it for fixed income, it's a little bit, it has to, because we have duration involved, we have the movement of the change. It has to go to the right instead of the left, which is we are actually we are dealing with the yield, not talking with the assets. So please follow with me, and if we understand that point, I think it's only the fixed income that is a little bit technical. So if we assume that the change in a yield is normally distributed, and this is one of the assumptions, that means the yield itself, which is the return, is actually normally distribution. And what do you mean by normally distribution? Means the mean is 0. If you take the returns during past time, say 1 year, 2 years, and then you just calculate the mean of the changes of the return or the yield, you will find it 0 because it's very symmetrical. So normal distribution is 1 and is symmetrical from the right side and the left side, and the return goes in those 2 sides, and therefore we assume when we talk about normal distribution that the mean will be 0. So the DIR is the market risk exposure over the next 24 hours. And we are talking, we are assuming normality with 90% of the time, which means we take 90% confidence within 1.65 standard deviation of the mean. And I will tell you why we are, this is how it looks. This is the return. For example, this is SP 500, and actually in live, it's the same thing. This is the biggest, what we call market index in the US, which is SPM 500. And it's normally distributed. If you take the return of the whole index, you will find it 0. This is collected, data collected, and it show you it's 0. So it's actually, this assumption is reflected in any other assets, and we assume that the normal distribution, if it is normally distributed, the return, then it will be, the mean will be 0. Having said that, we come to our example. So actually what we are going to do is calculate this area. Not this area. This is a normally distribution curve. And then we have the Z value. Now the Z value with 90% confidence, you can say 90% confidence, 95, but this is the Z values. And the Z values for these people who are in econometrics, and even if you are not in econometrics, this is how we do it. So the Z value will be in the left, which is minus Z, or in the right, which is plus Z. And if we are talking about 90% confidence, means here is 5% out of this area, and here is 5% out of this area. So to calculate the Z from the tables or from Excel, it's 1.645. And therefore, in the yield, when we are trying to check the yield, our concern when we have fixed income, which means bonds or government securities, is the drop in the price. And the drop in the price will happen when the interest rate is increasing. Because our price is the cash flow over 1 plus I. So when the I is increasing, which is the interest rate, of course, the price will drop. And so if we are holding big amounts of this fixed income securities, our concern is this drop. And now how to calculate this is actually depends on the standard deviation. So we multiply the standard deviation and we will transfer this to percentages, and we will see how the standard deviation times the Z value, and we will tell you how much is this area or the change, and based on the standard deviation of our portfolio, which means the standard deviation of the yield that goes up and down, then you will calculate this area and not really this area. So now suppose that we are having a long position, and you already know what is the long position. It's 7-year 0 coupon bonds, and we define by yield change as that there is only 5% chance of the yield change being exceeded in either directions, which means we are considering this to be 5%, and this is 5%, and there is a change, there is a possibility that this will be out of the 90% area. So we are calculating before the 5% here. Assuming now we have 1.65 standard deviation, which is this is the whole area that will change, which is 1.5 of the standard deviation, and the standard deviation is 10 basis points. Now I can transfer this to percentages, which means how much the percentages with 90%, how much the percentage in the yield can be changed with this confidence. Now this you can use, just I give you an example. This is, you have 90%, 165, 196, 258, and we are talking about two tails. Now come to our example. We are assuming 90% confidence, and if you say here, if the last year mean change in daily yield on the bond was 0, which means we expect this 0, so we don't add it to this change. So this is actually 0, and this is the distribution of the yield. So while standard deviation was 10 basis points, then this area is actually up to here, the changes in percentages will be 1.65 times the standard deviation. And this will tell us the daily yield on this have fluctuated more than 1.65, 10% of the time, which is 5% here and 5% is here. So the adverse move in the yield are those yields that decrease the value of the security. So we are not interested in this area. We are actually interested in this area, which is the adverse move. Now, because this will increase, if there is an increase in the yield, the price of the security will drop, and this is very normal. So our concern, the yield increases, and it occurred in 5% of the time. Why 5% of the time? Which means we are taking 90% confidence. 90% confidence, 5% of it is 1 day out of 20 days. If you want to transfer, what do we mean by 5% out of the 90 days? Okay, this is the 5% out of the 100, which is out of the 100, it's actually the 5% here, which is 1 day in 20 days. Now let's take this example using the information in the previous slides. I just gave you this background in econometrics, and I don't want you to worry about it, just to understand the concept. So actually, the concept here is using the information in the previous slides, calculate the potential adverse change in yield. We can calculate the daily price volatility first. So assume we have holding of 1 million market value position in 0 coupon bonds. It has 7 years maturity with face value of, after 7 years, 1,631,000. And today the yield on that bond is 2.43%, and the adverse in the yield is 11.65. Where did I get this one? I get it from the previous slide, which is this area, the standard deviation times the Z value, which is 16.5 basis point. Now it's easy for me to calculate the DIR because I need to calculate the daily price of volatility, and then daily price volatility is the, this is coming from the formula, which is modified duration times the potential adverse. I have the potential adverse. How can I calculate the modified duration? Modified duration is the duration over 1 plus R. I have the duration, which is 7 years, and I have R, which is 72.43. So in this case, I get it to be 6.527. This is the modified duration. Now, if I have the modified duration, I can calculate the daily price volatility. Now, the daily price volatility is the modified duration times the adverse movement. I get it to be 1.77. And this is the highest drop in the height increase in the yield. So the DIR is the market valuation of the position times the price volatility, which is actually the 1 million times the 1.077. This is the highest drop in my price volatility, which is 10,770. So I expect to lose 10,770 out of this 1 million in 1 day. But now we move to another issue. What if we wanted more than 1 day? We wanted, for example, for a week, and the week is 5 days. So we come to something called the bar. So the bar will take the DIR times the standard deviation, n under the square root. So when we take the 10, because if they say this is just a calculation of, if this is losses in 1 day, how much be the losses in 5 days. So this is the formula to use it, because it will not be the same amount, but will keep a little bit decreasing. This is why we use the square root. So it's 24.82. So this is what we lose in 1 week. You can make it for 10 days. You can make it for more than that. Now we are done with the fixed income. Let's come to the foreign exchange. Now foreign exchange is straightforward because we don't have yield. We just have to calculate the adverse movement. And when we calculate the adverse movement, we multiply it by the position. So we take the foreign exchange position, which means how many dollars we are investing in some position. And we calculate the changes in the spot exchange rate. This is what we calculate, the spot exchange rate. And then we can see how much we can lose in that position. So take this example. If I have 2 assets, if I have 2 holdings, I have euro, I'm a Australian company, for example, and I have a euro and British pounds. And I have actually 25 million of British pounds, and I have 20 million of euros. And I have the exchange rate, which is actually 40 cents and 1.28. I calculate this to be, maybe this 40 cents is not actually logic for the euro, but just take it like that. So we have $8 million actually, and we have 32 million. Now we transfer this to Aussies or the Australian dollars. Now we want to just calculate the Forex volatility. Now the Forex volatility for the euro is the 1.65 still. We are talking about the Z value times the standard deviation. Now the standard, the Z value is 1.65. The standard deviation for the euro is 65 basis points, the standard deviation. And this is 45 basis point. So we multiply it and we find this to be 107%, and this is to be 74 basis point. Now we want to calculate the DIR, so we take the value of the position, time the price volatility, and we will do it for each position, because we have one position in the euro and one position in the pound. So we find this to be 85,800, and we find this to be 237,600. So this is the DIR. This is in 1 day. According to this calculation and according to the move and the change in the exchange rate, historical exchange rate, and the Z value under the 90%. We didn't do anything. We just calculate under the 90% how much the change will be here, as I told you, in this area, under the 1.65. So we find this to be to get the VAR, we calculate the VAR times the 10 days under the square root, and then we get this amount. This is for 10 days, which means 2 weeks, 10 working days or 2 weeks. So 271,332,751. Same thing now when we come to the equities, it's the same thing. However, in the equities, if you look at one of the pricing model called CAPM, and CPM say the total risk is systematic risk and the systematic risk. Now, if the portfolio is well diversified, I can get out. I can get rid of the systematic risk, but the systematic risk will continue to be there. So we will for less well diversified, the effect of unsystematic risk on the value of the trading position would need to be added. So if you look at here, of course, for diversified, we can get rid of the largely out of the systematic risk, and this is the systematic. So both of them have to be added. If this is really eliminated, then we will be left only with the systematic risk. So the DIR is the dollar value of the position times the stock market return volatility, and this volatility is coming actually from the volatility of the index. Now, assume equity position is 1 million, and where the daily return volatility on the stock market index, we are taking the stock market index as an indicator of the volatility of our position in the equities, 2% under 90% confidence. So the market return volatility is taken as 1.65 for this standard deviation. So the Z value times the market volatility, and the market volatility, the position is 1 million. This is 1.65 under 90% confidence, and this is actually the volatility of the index of the market. So this is what I will lose, 33,000. This is the volatility of the market under 90% confidence. So I'm using the value, Z value. You can use 95, you can use 99, it's up to you. I mean, you just change the Z value, and the Z value can be changed easily. But the most important thing is actually the volatility here. Now we move to the risk matrix. A risk matrix is, because we have now the equities, we have the bonds, we have the fixed income, we have the foreign exchange, and we have the equities. If we add them up, according to the calculation, we can say, if we assume that this is 1077, this is 9320, and this is 33,000, this is 9320, this is new numbers. I give it to you just an example here. So if we have 1077 and 9320 and 33,000, just assumption. So if we add them up, we will find it to be 5390. But actually, the risk is overlapping because they came from the risk, the changes of the equity market, and the exchange rate is coming from the change in the interest rate and the exchange rate. And when the exchange rate and interest rates change, our holding in those assets change. And therefore, there is overlapping. And when we take the overlapping, we have to see how the correlation of the assets, of those assets, I mean, the return, the changes in the price, the correlation between them. And we find now the 7-year zero coupon have some correlation with the exchange rate, which is the dollar to the Swiss franc, 0.02. And we have this 7-year has also another correlation between the changes in the fixed income and also with the price index, share index, the dollar, the index, which is actually the changes in the equity. And then also we have a correlation between the exchange rate and the index, which is the equities. I take all of those and I put them in the formula, and the formula will be given to you. So we will bring Dir A, Dir B, Dir C. So this is the equity, this is the fixed income, this is the foreign exchange, this is the equities, and then the correlation between the first and the second, and the correlation between the first and the third, and then the correlation between the third, the second, and the third. And then we add them up all, and we want only the standard deviation of this, and we find it to be actually 39,969. This is the risk of all my portfolio. So we have to calculate the DIRs, and we have to put the DIRs in this matrix to get the aggregate risk. Now I'm done with the most technical one, but this model has problems. And one of its problems is to get these correlations. It's very difficult to get these correlations, especially when you have so many assets. Now we are talking only about one asset and one position in the exchange rate. What if you have so many assets and you have to calculate the correlation? And then this matrix will be so huge. This is one thing. Okay, we can solve this through advanced computer systems. No problem. But the problem is sometimes we cannot change, we cannot deal with the issue of, normality. The assumption here now, when we take the confidence level and the z-value, we are assuming all the time this issue is normally distributed, which is not always the case. So this problem have these weaknesses, and this is the weaknesses. The implementation is difficult, and then this assumption, the correlation and the normality. And therefore, we come to another model called the historic or back simulation. Historical back simulation should be very straightforward, which means we don't have to have econometrics to use econometrics or statistics, which we call it parametric methods. We just use the non-parametric. And non-parametric means we are not using actually normal distribution and statistics and distributions. So what they do is we have to measure something called the delta. I will show you in this example. Look, for example, here for the exchange rate, we have the Japanese yen. We have our investment. We have 500 million of Japanese yen, and we have 20 million of Swiss franc. And we are Australian company. And the exchange rate is $1 equals 100. And here, $1 equals 1.1. That's fine. This is when on the 1st of December 2019, for example. Now, how much my holdings in the Australian dollars is actually 5,018,081. There is no problem. Now, when we start to measure the sensitivity, please follow me step by step, because I will take you to the delta, and then from the delta, I will tell you what we are going to do. So the delta assumes that there is 1% change. 1% change in the current rate. So if this 1% change happens, which means your dollar, your JP Morgan, the Japanese yen will increase from 100 to 101. Same thing here, we increase from 101 to 1011. This is an increase of 1%. Now, when that increase in 1%, which means the Japanese is depreciating, this is the risk, and the Swiss franc is depreciating, which means my holding has been dropped from 5 million to 4,950,000, and here from 18,181 to 18,001. Now, this amount, this difference between the change, because of this change of 1%, which is adverse change, is 49,505, and this is 180. So this is actually the delta of 1% change. Now, if I know this is 1% change, I will just go and take the list of all this Japanese yen and Swiss franc for the past 500 days. And when I take it for the past 500 days, I will see how much the change. Is it 1%? Is it 50 basis points? Is it 30 basis points? Which means the change, the depreciation in the yen and the depreciation in the Swiss franc. How much was the change or the increase? And I multiply it by the delta. And I have to list it. And then when I list it, I will have 500 observations. I will sort them and choose the worst 25 days. Why 25 days? Because 25 days represents 5% of the observation, which is the 500 days. So you will take the last 500 days, see the changes, using the delta, transfer this to dollar values, sort them for the last 500 days, and then get the worst 25 days. That is your VAR. So in this case, this is the risk of 1 day. Now you repeat step 3, which is this step for the next 499 days. So you will rank the days by risk from worst to best, as I told you, and then you will take the VAR, which is the 25th worst days of the last 500. This is actually 5%. You don't have to worry about it, but this is how we calculate the VAR, and this is how the historic, what we call back simulation works. It's just the assumption of the delta, and then you continue and you calculate the change, transfer the change to dollars, and sort them and take the worst 25 days. This is the back simulation. Now, the problem with back simulation, they will tell you, as always, there is somebody who will come to criticize. The 500 observations may not reflect actually the changes, the actual changes in the future for the Japanese yen and the Swiss franc. It is not reflective. So you need to increase them. So they use something called Monte Carlo simulation. There is nothing, I don't know how many of you have done Monte Carlo simulation, but Monte Carlo simulation is actually, will use this method. They calculate matrices, they decompose the matrix into 2 matrices. This is all static work. You don't have to do it. Excel can do it for you. Some other programs can do it for you. And from the 500 days, which we have, the actual days, they can produce for you 10,000 or 20,000. And then you do what you have done in the back simulation. But in this case, you will list 10,000 observations, which is simulated. And you will take the worst 500 days, which is 5%. Last time we take only the worst 25 days, which out of the 500. Now we will take the worst 500 days, which is actually 5% of the 10,000 observations. This is how the Monte Carlo simulation works. There is no calculation in this at all. I'll just show it to you. I don't know whether I will have here calculation or no, but I need you to understand at least what we mean by the delta and what we mean and how we go through back simulation. And actually to solve this problem, the weaknesses of the other one. Now we come to the regulatory models. I don't want to spend much time here, and I don't want you to worry about it because I will not actually test it. But to tell you that the major ways of calculating market risk is simple standardized framework, use of internal models, and we can do this. So the purpose of the regulatory model is to calculate market exposure, so we can calculate the market risk. The market risk, which is the capital, as we said. So we there is distinction between specific risk charges, which is the risk weights, absolute dollar values of long and short positions, because we have two positions, you have to take the difference between them, and you have the general market risk charges. So this is related to specific firms, and this is actually related to the market. And you have to and then because the changes, there is changes in the interest rate, the impact on the liabilities will be different from the impact of the assets. So you have to adjust for this risk basis, which means sometimes the interest increase in the assets and liabilities are different. So you have to adjust for this basis. This is what they do for the fixed income and the regulatory approach. For the foreign exchange, they take standardized model requires calculation of the net exposure. So what we mean by net exposure, I have investment in so many currencies. Some of them are gaining, some of them are losing. But end of the day, when you make net calculations, it will give you the net net exposure in the foreign exchange, and you have to multiply this by the net exposure to be converted into dollar value based on your positions, and this has to be multiplied by 10.5% as your capital. This is how they do it actually, because you have so investment in so many currencies. You will see what is your net exposure multiplied by the dollar value and multiplied by 10.5% to get the impact on the risk and add it to the capital. So you have to, when you calculate the capital adequacy, this we'll talk about it in week 11. For the equities, we have to talk about unsystematic risk and systematic risk, and usually they take 4% in equities, and so the BIS and systematic risk, they take 4% for the positions in equities, and 4% for the 4% for the systematic risk, and 4% for the unsystematic risk. Now they calculate, they use 99% confidence. They have something called the internal models. So this is not internal models. This is the standard models. The internal models, they make sometimes like normal distributions, and they bring all the risks inside for each item, and they just calculate the bar, which is based on the movement, and the 99% confidence. So if they take, for example, the equities or exchange rate or foreign fixed income, so they will calculate the changes based as we did in the beginning, according to the 99% confidence, and then we'll multiply this by the position, and that actually will be their exposure. And then they will calculate what we call the VAR for 10 days and VAR for 60 days. So the VAR for 10 days is actually the DIR times 10 days under the square root. And this is their approach when they want to calculate for 60 days. So they multiply by 3, and this is where they get. If you want to read more, you can read from big to 329 to 355 and long at all. That's all actually for the second part. Regulatory models actually are very straightforward. Don't worry about it. But I'm not testing on that. But it is very, very straightforward. Thank you very much. I will stop sharing. And this is actually the end of the recording for this week. Thank you, and see you in class, and good luck.